He checked his savings account on a Tuesday morning. Just a habit, part of the routine. Balance, $4,200. Same as last month. Same as 6 months ago. He scrolled down to the interest earned column. $1.42. For the entire year. He thought the app had glitched. It hadn't. That was the number Chase gave him for 12 months. $1.42 on $4,000. Meanwhile, groceries were up again. Rent went up $300 in January. Gas hasn't been cheap since 2020. His paycheck hadn't changed either. But everything around him had gotten more expensive. He'd been doing everything right. Steady job, no credit card debt, money in the bank. Except the bank wasn't doing anything with his money. Nothing he could see anyway. He put his phone down and went to work. Eight hours later, Chase had made millions. He had made his hourly rate. That gap has a name. It's not called a savings account. It's called a spread. And the spread is the whole point. Let's talk about what actually happened to his $4,000. Not the story the bank tells, the other one. Chase, Bank of America, and Wells Fargo all pay 0.01% APY. That's the standard rate on a traditional savings account. 0.01%. On $10,000, that's $1 per year. Per bank rate, confirmed as of March 2026. Not a promotional rate, not a penalty rate. The standard rate for most of their customers. For most of their lives. Meanwhile, inflation ran 2.9% in 2024, per the Bureau of Labor Statistics. That means prices rose nearly 3 cents on every dollar you held. Your savings account paid back 1/10 of 1 cent. The math is not close. You lost ground every single month. Quietly, automatically, by design. From 2021 to 2024, cumulative inflation hit roughly 19% per BLS CPI data. $100 in 2021 buys about $81 of goods today. Your Chase savings account did not help with that. It gave you fractions of a penny while prices rewrote the menu. This is called losing purchasing power. The bank has a different word for it. They call it a standard savings account. Standard, as if losing money slowly is just the default. As if that's what saving is supposed to feel like. Let's look at what the bank does with your deposit. You put $4,000 into Chase. Chase takes that money and lends it out. Mortgages, auto loans, credit cards. Credit cards charging 24, 27, 30% APR. Your $4,000 is working very hard. Just not for you. JP Morgan Chase made $14 billion in a single quarter. Q4 2024, $14 billion, one quarter. The four largest U.S. banks collected $88 billion in profits. First 9 months of 2024, per the Financial Times. That's not revenue, that's profit. After expenses, after salaries, after everything. $88 billion. And they paid their savings customers $1 on 10,000. That's not a coincidence. That's a business model. Here's how it works at the mechanical level. Banks borrow your money at 0.01%. They lend it back to other customers at 10, 20, 30%. The gap between those two numbers is called the net interest margin. It is quite literally the bank's profit on your deposit. The wider the gap, the more they keep. Paying you less is not an oversight. It is the optimization. The FDIC tracks the national average savings rate across all U.S. banks. As of early 2026, that average sits at 0.39%. Still below inflation, still losing ground. Even the average is a losing position. And 45% of Americans stick with their big bank anyway. Per a bank rate survey, the top reason is branch access. They want to be able to walk in. The bank charges them for that preference. Silent, monthly, forever. Half of Americans have less than $500 in savings. Per a Go Banking Rate survey from December 2024. Less than $500. And that $500 is sitting in an account earning nothing. The median American household holds about $8,000 in transaction accounts. Per the Federal Reserve's survey of consumer finances. $8,000 at 0.01% earns 80 cents a year. 80 cents. Less than a candy bar. For a full year of trusting the bank with your emergency fund. The bank trusted you too. Trusted you not to notice. Most people didn't. Now look at it from their side. You walk into Chase with $8,000. You hand it over. No questions asked. They promise to keep it safe. You shake on it. What you didn't negotiate was the rate. They set the rate. You accepted it. And the rate they set was 0.01%. Not because that's all they could afford. JP Morgan just posted $58 billion in full year 2024 net revenue. They could afford more. They chose not to pay it. Because you didn't ask, and most people don't. Here's the part that should make you stop. The bank earned $14 billion last quarter. You earned $1 all year. Same transaction, different side of the desk. Now here's the twist that most people never see. Online banks exist that pay 4% APY right now. Not a promotion, not a gimmick. VO Bank, Axos, Wealthfront, all paying around 4% as of March 2026. That same $8,000 earns $320 a year versus 80 cents at Chase. Same FDIC insurance, same federal protection up to $250,000. The money is just as safe. The bank is just less comfortable. No branch on your corner, no teller who knows your name. Just 400 times more interest on your own money. $400 times. That number is not a typo. Competitive high-yield accounts pay over 400 times the standard big bank rate. Per bank rate, confirmed current as of this month. Huh? So why don't people switch? Inertia, familiarity, the branch on the corner. And the bank knows this. They have studied it. They have counted on it. The technical term for what they're collecting from you is called the loyalty tax. You pay it every month you stay. You pay it in purchasing power you never see leave. It doesn't show up as a fee on your statement. It shows up as a number that never grows. While everything around you does. The system didn't malfunction. It worked. You were the product. Your deposit was the inventory. And the markup was 400 times what they paid you. That's not banking. That's arbitrage. On your emergency fund. While you were at work, so here's what you can actually do about it. Not theory, not someday, right now, this week. First tool, a high-yield savings account. Online banks, no branches, no overhead, no excuses. Bank is paying 4.03% APY as of March 2026. Axos is paying 4.21%. Wealthfront is at 4.20%. All FDIC insured, all accessible online. Minimum deposit at most of these, $0. You don't need a lot of money to start earning real interest. You need a different bank. Opening one takes about 5 minutes online. Link it to your existing checking account. Transfer your savings over. Keep your Chase account if you want the branch. Just stop storing your money there. That one move on $8,000 nets you $319 extra dollars a year. For doing nothing differently except where you keep it. Second tool, Series I savings bonds from the U.S. Treasury. Issued directly by the federal government, zero bank involved. Current rate, as of November 2025, 4.03% annualized per treasurydirect.gov. The rate adjusts every 6 months based on official inflation data. When inflation goes up, your rate goes up with it. That's the whole design. Inflation protection built in by law. Minimum purchase, $25. You don't need $1,000 to start. You need $25 and a treasurydirect.gov account. Maximum per person per year, $10,000. Catch: you can't touch it for 12 months. After 5 years, no penalty at all. For emergency funds you won't need immediately, this is hard to beat. Third tool, money market accounts at credit unions. Credit unions are member-owned, not shareholder-owned. They don't have a profit motive that runs against your interest. Many pay between 3 and 4% right now. No minimum balance at several. No monthly fees. Your deposits are insured by the NCUA, the federal equivalent of the FDIC. Same protection, different ownership structure. Fourth tool, short duration U.S. Treasury bills. 3-month and 6-month T-bills currently yielding around 4%. Backed by the full faith and credit of the United States government. Purchasable directly at treasurydirect.gov with no broker fees. or through any major brokerage account in under 10 minutes. You are lending money to the government instead of Chase. The government, unlike Chase, is paying you a competitive rate. None of these tools require a financial advisor. None require a minimum income. None require you to take on stock market risk. They require one thing: moving your money somewhere that respects it. The bank was never going to tell you this. That's why we're here. Here's the one most people never find. The U.S. Treasury has a loophole hiding in plain sight. It's called the Series I Savings Bond. And the bank has no interest in telling you it exists. You go to treasurydirect.gov. You open a free account. You buy $25 worth of I-bonds. $25. That's the floor. The government pays you 4.03% and adjusts for inflation automatically. No broker, no advisor, no Chase, no Wells Fargo. Just you and the U.S. Treasury, cutting out the middleman entirely. The big banks have known about this for decades. They just never mentioned it at the branch. Page 47, footnote 3, font size 6. If it's there at all. The median American household has $8,000 sitting somewhere. At 0.01%, that earns 80 cents a year. At 4.03% in I-bonds, that earns $322. The difference is $321.20. Per year, every year, without touching anything else in your life. Your savings account isn't broken. It's working exactly as designed, just not for you.